Hello everybody, I'm delighted to be with you today for this webinar to discuss the Hong Kong Stock Exchange's latest consultation paper on the proposal to revise the Corporate Governance Code and related listing rules. We're going to begin today with an overview and background of the consultation paper. I'll then look at the proposals as set out in the consultation paper in detail, and we'll discuss their practical impact on companies and their boards of directors. On the 16th of April 2021, the Hong Kong Exchange published a consultation paper on the review of Corporate Governance Code and related listing rules, setting out proposals aimed at promoting good corporate governance practices among Hong Kong listed companies and IPO applicants. Specifically, the consultation paper aims to achieve 6 main goals. First, to highlight the importance of corporate culture in alignment with the listed company's vision and strategy to deliver long-term sustainable performance. The Hong Kong Exchange emphasizes that a healthy culture is of paramount importance to good corporate governance. The board should demonstrate good practice and promote governance throughout the business. The Hong Kong Exchange also notes that listed companies should demonstrate openness and accountability as a whole and should engage constructively with shareholders and stakeholders about the culture. The second goal is to enhance board independence, promote board refreshment and succession planning, and strengthen the role of the nomination committee. The Hong Kong Exchange reiterated in the consultation paper that directors' independence has been a major focus and stressed the importance of ensuring that INEDs make a contribution to the company that is commensurate with their role and board responsibilities. Third, to promote board diversity of listed companies. In this regard, gender diversity is a main focus of the consultation paper. Diversity is considered by the Exchange as an important driver of board effectiveness, creating cognitive diversity in the board and breaking down a tendency towards groupthink. The fourth goal of the consultation paper is to improve and emphasize the importance of effective communications with shareholders and stakeholders. The Hong Kong Exchange stresses the need for communication to enable listed companies to disseminate information relating to the listed company and to facilitate the board to effectively solicit and receive feedback on how the company is perceived by shareholders and stakeholders. The Hong Kong Exchange's fifth aim is to elaborate on the link between corporate governance and environmental and social governance, ESG, and to improve the timeliness of ESG reports by aligning the publication timeframe of ESG reports with annual reports to facilitate shareholders and investors' understanding of the company's performance in a more comprehensive manner. The consultation paper also highlights that corporate governance and ESG measures should not simply be a box-ticking exercise for listed companies, and that the Hong Kong Exchange is committed to supporting the entire listed company community by providing training and publishing guidance materials in order to improve attitudes to ESG and corporate governance. And finally, the Hong Kong Exchange aims to improve the flow and readability of the Corporate Governance Code. The consultation paper demonstrates that the Hong Kong Exchange is committed to reviewing the corporate governance framework from time to time in order to ensure it remains fit for purpose and improving the quality of governance among listed companies and to maintaining investors' confidence in the market. The Hong Kong Exchange reviews, consults on and amends the Corporate Governance Code once every few years to take into account market developments, its observations from its analysis of corporate governance disclosure, and the opinions of professional and market practitioners and industry groups, including those representing investors. I look now at the proposed amendments under the consultation paper. This covers 6 areas of corporate governance, which are corporate culture of Hong Kong listed companies, board independence, board diversity, the requirement for a nomination committee, communication with shareholders, and other enhancements in relation to the appointment and disclosure of directors. The consultation paper also sets out other proposals, including ESG-related amendments and rearranging the structure of the Corporate Governance Code. With regard to the culture of Hong Kong listed companies, the Hong Kong Exchange is proposing to introduce a new code provision which will require a company's board to align the company's culture with its purpose, value and strategy as established by the board. The Hong Kong Exchange will provide guidance to explain the board's role in culture, set out the key elements commonly identified in a sound culture, and recommend key issues which may be helpful to stakeholders in understanding a company's culture. This proposal is in line with the global trend, as other jurisdictions such as the UK, Australia, and Singapore have recently introduced similar rules requiring listed company boards to establish an appropriate culture and to ensure its alignment with the company's strategy and values. While the Hong Kong Exchange acknowledges that there's no one-size-fits-all when it comes to the culture of listed companies, the consultation paper notes that a sound culture commonly features certain elements. The first of these is that the board should set the tone from the top. The board should be responsible both for setting the company's culture and for ensuring that it's embedded at all levels of the organisation. The board should also conduct periodic reviews of the listed company's culture to ensure that it's aligned with the company's purpose and value and is able to generate long-term sustainable growth. Employees at all levels of the listed company should understand the core values of the company's culture and be able to perform their prescribed roles and be held accountable for their actions. The company's culture should also facilitate effective communication and challenge to encourage expression of a range of views. The Hong Kong Exchange also points to the use of financial and non-financial incentives to encourage and maintain companies' desired culture. The Exchange also encourages listed companies to disclose information about their culture to facilitate stakeholders' assessment of the company. Again, the Exchange acknowledges that there's no one-size-fits-all solution to the scope of disclosure, but it provides a list of matters that may usefully be included in disclosures of company culture. These include a description of the vision, value, and strategy, and the culture of the listed company and how these affect the company's business model. A description of indicators of the company's success, for example, its key performance indicators in terms of revenue growth, profit margins, return on equity, and market share, and a discussion of how the listed company's desired culture could affect its performance. A discussion of the measures used for assessing and monitoring culture, for example, any specific indicators such as turnover rate, whistleblowing data, employee surveys, breaches of code of conduct, and regulatory breaches. A description of the measures in place to ensure the desired culture and expected behaviours are clearly communicated to all employees, for example, by developing an internal code of conduct. Information on the forums available for sharing ideas and concerns on any identified misconduct and how it's dealt with. A discussion of the listed company's financial and non-financial incentives which support the desired culture. The consultation paper also focuses on anti-corruption and whistleblowing policies, which are considered essential to establishing a healthy corporate culture. Currently, Hong Kong Stock Exchange listed companies are required on a comply or explain basis to make anti-corruption related disclosures under the ESG guide in Appendix 27 to the main board listing rules and Appendix 20 to the GEM listing rules, including in relation to their anti-corruption policies, whistleblowing procedures, and compliance with relevant laws and regulations. In order to further promote the importance of anti-corruption and whistleblowing, the Exchange is proposing to introduce a new code provision requiring companies to establish an anti-corruption policy and to upgrade an existing recommended best practice requiring companies to establish a whistleblowing policy to a code provision under the Corporate Governance Code. As I'm sure many of you know, there are two levels of recommendations under the Corporate Governance Code. Firstly, code provisions, and secondly, recommended best practices. For the code provisions, while companies are expected to comply, they may choose to deviate from them, provided that they give considered reasons for the deviation in their interim reports and annual reports. The recommended best practices, on the other hand, are standards which companies are encouraged to adopt but are provided for guidance only. Companies are encouraged but not required to disclose their compliance with the recommended best practices and to give considered reasons for not complying with them. The Hong Kong Exchange will provide further guidance to assist companies' compliance with the new requirements, which will set out the factors that need to be taken into consideration when formulating anti-corruption and whistleblowing policies. These are expected to include a statement reflecting the listed company's commitment, the scope of the policy, the committee or personnel responsible for implementing the policy, and the reporting channels. The Exchange will also include references to the SFC's guidance on anti-money laundering and counter-terrorist financing, and the ICAC's guidance materials on anti-corruption. In relation to listed companies' boards of directors, the Hong Kong Exchange is committed to further enhancing board independence. The criteria for assessing the independence of independent non-executive directors under Main Board Listing Rule 3.13 were tightened in January 2019, following the latest review of the Corporate Governance Code and related listing rules. The amendments strengthened the independence criteria, first by extending cooling-off periods for companies' former professional advisors or interested parties before they can become INEDs, from 1 year to 2 years. They also included immediate family members in the independence assessment. The January 2019 amendments also introduced a recommended best practice that companies should disclose an INED's cross-directorships or significant links with other directors in the corporate governance report. Under the current consultation paper, in order to further promote and strengthen board independence, the Exchange is proposing to introduce a new code provision requiring companies to adopt and disclose a policy to ensure that independent views and input are available to the board. The code provision will also require company boards to conduct an annual review of the implementation and effectiveness of the policy. The Exchange also proposes to strengthen listed companies' board refreshment and succession planning. According to the consultation paper, as of December 2020, 17.8% of INEDs of Hong Kong Exchange-listed companies were so-called long-serving INEDs. That's INEDs who'd served more than 9 years. There were 153 companies where every INED on the board was a long-serving INED. The Exchange notes its concern that where an INED serves on a company board for a long period of time, there's a risk that the board becomes overly dependent on one person, or that the individual's familiarity with the board leads to complacency. While acknowledging the value of long-serving INEDs and their knowledge of company affairs, the Exchange stresses the importance of an individual's independence. The Exchange also thinks that periodic board refreshment can bring new perspectives and ideas which improve board effectiveness and enhance accountability. It's currently a code provision of the Corporate Governance Code that a further appointment of an INED who's already served 9 years or more must be passed by a separate shareholders' resolution. The board's reasons for considering the candidate to still be independent and why that person should be re-elected are required to be set out in the papers sent to shareholders with the resolution. Under the consultation paper, the Exchange is now proposing to revise the existing code provision on the reappointment of long-serving INEDs so that their appointment will be subject to approval by the company's independent shareholders only. The Hong Kong Exchange is also proposing to require additional disclosure in the explanation of why the long-serving INED is independent and should be elected. The papers sent to shareholders will need to set out the factors considered by the board or the nomination committee in reaching that decision, the process and the board or the nominations committee's discussion in arriving at that decision. If all the INEDs on a listed company's board are long-serving INEDs, a proposed new code provision would require the listed company to appoint a new INED at the next AGM and disclose in the shareholders' circular the length of the tenure of the long-serving INEDs on the board on a named basis. Additionally, given the importance of INED's objectivity and independence in scrutinising board decisions, the Exchange proposes to introduce a new recommended best practice that companies generally should not grant equity-based remuneration, such as share options or grants with performance-related elements to INEDs. This is to avoid conflicts of interest, which may lead to bias in INED's decision-making and compromise their objectivity and independence. With respect to board diversity, the current Corporate Governance Code requires listed company boards to have a balance of skills, experience, and diversity of perspectives appropriate for the company's business. The listing rules further require listed companies to have a diversity policy and to disclose the policy or a summary of it in their corporate governance report. However, the definition of diversity is broadly defined under the note to Listing Rule 1392, which states that diversity of board members can be achieved through consideration of a number of factors, including but not limited to gender, age, cultural and educational background, or professional experience. Gender is just one of the factors that can be used to demonstrate diversity. The disclosure of the board diversity policy is required to include any measurable objectives that have been set for implementing the policy and the listed company's progress in meeting those objectives. It's also a comply or explain provision that companies should disclose diversity considerations when appointing an INED. Since May 2019, the Hong Kong Exchange has required listing applicants to disclose their board diversity policy in their prospectus. Listing applicants with a single gender board are also required to make additional disclosures, including how and when the board will achieve gender diversity after listing, and as to what measurable objectives have been set to achieve gender diversity. However, according to a report quoted in the Hong Kong Exchange's Consultation Paper, women held only 12.7% of Hong Kong listed companies' directorships in 2020. As of December 2020, around 32% of listed companies had no female directors on the boards, and a further 37% had just one female director. In order to enhance gender diversity on the boards of Hong Kong listed companies, the Exchange is proposing to expressly highlight that diversity is not considered to be achieved by a single gender board in the note to Main Board Listing Rule 1392 and Gem Rule 17.104. It's also proposing to introduce as mandatory disclosure requirements an explanation of how and when gender diversity will be achieved in respect of company boards and across their workforces, including senior management, and disclosure of the numerical targets and timelines set to achieve gender diversity on their boards and across the workforce. Companies will also be required to disclose the measures adopted to develop a pipeline of potential successors to the board and senior management to achieve gender diversity. Once the revised listing rules take effect, there will be a transition period of 3 years to allow companies with single gender boards to appoint at least one director of the absent gender to their boards. IPO applicants should not have single gender boards. In this regard, the Hong Kong Exchange proposes to amend the relevant forms, Part 1 of Form B and Form H of Appendix 5 to the Main Board Rules, Part 1 of Form A and Form B of Appendix 6 to the Gem Rules, to require directors to provide this information on appointment. To further promote and enhance transparency of the board and diversity information, the Hong Kong Exchange plans to display board diversity-related information, including information such as age, gender, and directorships of the directors on the Exchange's website. The Hong Kong Exchange is also proposing to introduce a code provision to require company boards to annually review the implementation and effectiveness of its board diversity policy, which all companies have been required to establish and disclose in their corporate governance reports since January 2019, and make a statement in relation to the review in the company's annual report. The Hong Kong Exchange's proposals aimed at promoting gender diversity in the boardroom are in line with trends in other major financial centres. For example, in Australia, initiatives have been introduced to promote gender diversity on the boards of ASX 200 and ASX 300 companies through an initiative known as the 30% Club, which promotes gender through diversity, which was launched in May 2015. The primary objective of the 30% Club is the campaign aimed at achieving greater representation for women on the board of ASX 200 and ASX 300 companies. For ASX 200 companies, the aim was to achieve a 30% representation of women on the board of ASX 200 companies by the end of 2018 and 30% representation of women on the boards of ASX 300 companies by the end of 2021. In the United Kingdom, the UK government launched the UK Treasury Women in Finance Charter in March 2016, which is aimed at improving gender balance in senior management of companies in the financial services sector. Speaking recently at the UK Treasury Women in Finance Charter Annual Review, the Financial Conduct Authority reiterated the fundamental importance of diversity and inclusion within the financial services sector, while recognising the importance of further work to be done to improve diversity in senior management of companies in the financial services sector. And finally, in the United States, in December 2020, NASDAQ filed with the US SEC a proposal for new listing rules with respect to gender diversity and their disclosure. The NASDAQ proposal included a comply or explain mandate in relation to board diversity and also included a disclosure mandate, which would require NASDAQ-listed companies to provide statistical information relating to the diversity of the company's board of directors. It's clear from initiatives like these that the importance of board diversity is gaining traction and positive steps are being taken to promote and further encourage the transformation of boards. Given that Hong Kong has lagged behind other international financial centres in relation to board diversity, we envisage the proposals in the consultation paper aimed at promoting and accelerating board diversity for Hong Kong exchange-listed companies will be accepted. In particular, I anticipate strong support from certain organisations which are established with an aim to improve diversity, such as the 30% Club, Hong Kong, and Board Diversity Hong Kong. With regard to the nomination committee requirement for the Hong Kong exchange-listed companies currently under Code Provision A51 of the Corporate Governance Code, companies are required to set up a nomination committee on a comply or explain basis. The nomination committee should be chaired by the chairman of the board or an INED and comprise a majority of INEDs. It is also a mandatory disclosure requirement that companies should disclose in their corporate governance reports their policy for nominating directors, including the nomination procedures, process and criteria adopted by the nomination committee or the board to select and recommend candidates for directorship. This section of a listed company's corporate governance report should also include the board's policy or a summary of the policy on board diversity, including any measurable objectives that it has set for implementing its policy on board diversity and the progress on achieving these objectives. It's reported that 95% of the companies have established a nomination committee with a majority of INEDs and chaired by the board chairman or an INED. The Hong Kong Exchange reports in the consultation paper that the majority of listed companies have complied with the disclosure requirement. In order to strengthen the process for nominating and appointing directors, including INEDs, and to emphasise the importance of oversight of board nomination and recruitment, the Hong Kong Exchange is now proposing that the code provision requiring companies to establish a nomination committee chaired by an INED and comprised of a majority of INEDs should be upgraded to a listing rule. This is proposed new Main Board Listing Rule 3.27a, GEM Listing Rule 5.36a. The consultation paper notes that the US exchanges require a nomination committee to comprise entirely INEDs under the New York Stock Exchanges and NASDAQ rulebooks and listing rules, while Australia, Singapore, and the UK adopt a position similar to Hong Kong, requiring companies to establish a nomination committee with a majority INEDs on a comply or explain basis. In relation to the nomination committee, the Hong Kong Exchange will further set out in the guidance the expected disclosures regarding INED nomination and appointment, including the channels used in searching for appropriate INED candidates and the potential contribution to the board in terms of their qualifications, skills, and experience. The Hong Kong Exchange believes that these proposals, taken together with the current requirements, would enhance transparency and independence of the INED nomination and appointment process and promote better standards. In relation to communications with shareholders, currently under the Hong Kong Exchange's Corporate Governance Code, the board should be responsible for maintaining an ongoing dialogue with shareholders, and in particular, use AGMs or other general meetings to communicate with the shareholders and encourage their participation. The board should also establish a shareholder communication policy and review it on a regular basis to ensure its effectiveness. The Exchange aims to facilitate effective communication between listed companies and shareholders. It proposes to upgrade Code Provision E14 of the Exchange's Corporate Governance Code to a mandatory disclosure requirement. This will require that the board of a Hong Kong Exchange-listed company establish a shareholders' communication policy and review it on a regular basis to ensure its effectiveness. The shareholder communication policy should also include channels for shareholders to express their opinions on various matters relating to the company and steps taken by the company to solicit and understand shareholders' and stakeholders' views. The Exchange will also provide guidance setting out situations where companies are expected to provide more information to shareholders and practical ways in which companies can consider improving communication with shareholders. For example, appointing a senior INED or an investor relations officer who will be given direct access to the board. The Hong Kong Exchange will also include in the guidance areas where companies may provide more information in order to give shareholders a better understanding of the board's performance. These areas include the company's business strategies going forward and its plan to cope with an economic downturn or a global pandemic if appropriate, commercial rationale behind commercial transactions, including notifiable transactions, M&A transactions, and connected transactions, and the board's discussion, in particular any dissenting views or challenges raised by individual directors. The directors' appointment process and succession planning, remuneration structure, including for directors and executives, and dividend distribution. This proposal and the proposed guidance will be in addition to the existing Hong Kong Exchange listing rules, reporting requirements, which include, for example, a requirement pursuant to the Exchange's listing rule 1458.8, that's Gem Rule 1958.9, that companies set out the reasons for entering into a transaction and the benefits which are expected to accrue to the listed company as a result of the transaction. The Exchange also takes the opportunity to address market discussions in relation to appointing a lead or senior INED. While noting that a lead or senior INED may facilitate the communication between the company and its investors and enhance INED's accountability, the Exchange also sets out that there are concerns with this approach. In particular, the Exchange explains that there are concerns about the difficulties in finding candidates who are willing to take up the position of a lead or senior INED. In addition, the Exchange also notes its concern that appointing a lead or senior INED may create a hierarchy amongst INEDs. Having said that, the Exchange, in its proposals, explains that it encourages companies to consider appointing a lead or senior INED as an intermediary for other directors and shareholders to facilitate investors' access to the board. In the proposed guidance, the Exchange will also suggest other practical methods which companies may consider adopting to improve communications with stakeholders. These include appointing a suitably qualified investment relations officer who has access to the board, formalizing periodic meetings with stakeholders, enhancing disclosure in respect of INED's contribution or work done during the year in the annual report, and conducting evaluation of board performance and disclose a summary of it in the internal report. In addition to the proposals that I've just talked about, there are additional proposed enhancements to the Hong Kong Exchange's Corporate Governance Code, some of which will require amendments to the current Exchange listing rules or the addition of new listing rules. The changes relate to three areas: disclosure on directors' attendance records at general meetings, disclosure on audit committee work, and deletion of specific term of directors. Currently, under Mandatory Disclosure Rule 1C of the Corporate Governance Code, directors' attendance at general meetings must be published in the company's corporate governance report at the year end. To promote corporate governance transparency, the Exchange proposes to introduce a new listing rule requiring companies to disclose directors' attendance at general meetings in the poll results announcements. The Exchange noted that under the current practice, there could be a substantial delay between the general meeting and the disclosure of the directors' attendance. Under the proposal that the directors' attendance will be disclosed at general meetings in the poll results announcements, there will no longer be such a delay. The Exchange is of the view that a timely disclosure of the directors' attendance record could be useful for shareholders and investors to assess directors' commitment in the company's affairs and their performance. With regard to the disclosure in relation to the Audit Committee, the Exchange noted that companies have provided limited disclosure on the Audit Committee's work, with many companies having resorted to copying the terms of reference of the Audit Committee while failing to disclose how the Audit Committee performed its duties and discharged its responsibilities during the reporting period. Currently, under the Corporate Governance Code, the board of a listed company should establish formal and transparent arrangements to consider how it will apply financial reporting, risk management, and internal control principles, and maintain an appropriate relationship with the company's auditors. The Audit Committee established under the Exchange's listing rules should have clear terms of reference, which should at least include that the Audit Committee reviews and monitors the external auditor's independence and objectivity and effectiveness of the audit process, Code Provision C33 of the Corporate Governance Code. In addition, pursuant to paragraph LD4 of the Mandatory Disclosure Requirements of the Corporate Governance Code, companies should disclose in a report a summary of the Audit Committee's work and how it met its responsibilities during the period or the year in the annual report. The Exchange views board committees, including the Audit Committee, as playing an important role in ensuring that a company's corporate governance structures are sound and effective. As part of its proposals, the Exchange encourages its companies to provide informative summaries of work done by each of the board committees in order to enhance corporate transparency and accountability. In this regard, the Exchange will help facilitate a company's compliance with these requirements by setting out in the proposed guidance what the Exchange expects to be disclosed in relation to the Audit Committee's work performed in the discharge of its responsibilities under the listing rules, which would include financial reporting, how the Audit Committee monitors and assesses the integrity of the financial reporting disclosures, as well as significant accounting judgments, and whether careful considerations are made throughout the financial reporting disclosures. External auditor, how the Audit Committee reviews and monitors the relationship with the external auditor and non-audit services, and whether the Audit Committee has challenged and assessed the external audit process. The internal audit, the process of overseeing the internal audit function of the company and the assessment of the overall governance, risk management, and internal control framework and the effectiveness of internal controls, whilst ensuring that management has appropriate internal controls over financial reporting. With regard to the specific term of directors under the current code provision A41 of the Corporate Governance Code, companies are required to appoint non-executive directors for a specific term, subject to re-election on a comply or explain basis, which is referred to as the specific term CP in the consultation paper. On the other hand, under the current code provision A42 of the Corporate Governance Code, all directors should be subject to retirement by rotation at least once every 3 years, which is referred to in the consultation paper as the rotation CP. Both code provisions require companies to periodically seek shareholders' approval in relation to the re-election of a director, which gives shareholders a means to voice their support or their disapproval of the directors through the exercise of their voting power. The exchanges noted that in practice, most companies align the appointment term with the period of rotation, 3 years, for administrative convenience. The exchange also notes that almost all companies who deviated from appointing non-executive directors for a specific term explained that the specific non-executive director to be appointed were already subject to retirement by rotation. Therefore, the two code provisions, that's the specific term CP and the rotation CP, seem to achieve the same result. That is, they allow shareholders to vote out certain directors. So to avoid this duplication and to reflect practical considerations, the exchange proposes to delete the current code provision A41, the specific term CP, which requires companies to appoint non-executive directors for a specific term. In relation to ESG amendments, and as oversight and implementation of ESG matters and the management of ESG risks are important parts of good corporate governance, the exchange has taken the opportunity to remind companies that the ESG measures, and they've said this before, are more than a tick box exercise, and that change needs to begin with a shift in mindset, starting with the leadership of the company. The exchange has explained that they're committed to continuing to assist companies to hold workshops and publish guidance materials on corporate governance and ESG-related matters. One example is the exchange's brochure, Making Inroads into Corporate Governance and ESG Management, which was published in December 2020 and gives listing applicants an insider's perspective from industry professionals into a range of corporate governance and ESG-related matters. The exchange also noted in the consultation paper that to reinforce the importance of corporate governance and ESG, the exchange will review the corporate governance ESG disclosures in the prospectuses of listing applicants to provide further guidance to IPO applicants this year. As part of the exchange's proposals in relation to the relationship between corporate governance and ESG, the exchange proposes to provide further guidance and information in the Corporate Governance Code by setting out the relationship between corporate governance and ESG, and by including ESG risks in the context of risk management. Currently, under Principle C2 of the Corporate Governance Code, the board is responsible for evaluating and determining the nature and extent of the risks it's willing to take in achieving the issuer's strategic objectives and ensuring that the issuer establishes and maintains appropriate and effective risk management and internal control systems. The board should oversee management in the design, implementation and monitoring of the risk management and internal control systems, and management should provide a confirmation to the board on the effectiveness of these systems. The ESG reporting guide set out in Appendix 27 to the Hong Kong Exchange's listing rules provides a framework for companies to identify and consider what environmental risks and social risks may be material to them. The board should be responsible for governance of ESG matters to ensure oversight of ESG matters, as well as assessment and management of material environmental and social risks. It's also stated that companies are required to disclose environmental and social matters in ESG reports in accordance with the ESG reporting guide in the proposed introductory section. While Principle C2 does not explicitly define these relevant risks, in FAQ Series 17, the exchange elaborated that as different companies face different risks, operate on different scales and in different geographical locations, Principle C2 of the Corporate Governance Code should refer to all material risks in connection with the company's businesses, which should include material risks relating to ESG. So as part of the exchange's proposals, it proposes to include ESG risks in Principle C2, which would be the new Principle D2. This will explain and bring ESG risks into the scope of the responsibility of the board, which will mean that the board is responsible for evaluating and determining the nature and extent of these risks within the context of risk management. Additionally, to facilitate shareholders and investors' understanding of the company's holistic performance, it's proposed to align the publication framework of ESG reports with annual reports. As ESG and climate-related risks continue to gain importance globally, the exchange has noticed a trend amongst regulators of different jurisdictions calling for the adoption of the recommendations of the Task Force on Climate-Related Financial Disclosures while reporting on climate-related information or making investment decisions. The Hong Kong Exchange's ESG reporting requirements that came into effect in July 2020 have incorporated certain elements of the TCFD recommendations. For example, under paragraph 13 of the ESG guide, a company is required to disclose a board statement setting out the board's oversight and governance of ESG matters, and on a comply or explain basis disclose significant climate change impacts that are material to companies and targets for certain key performance indicators under the environmental subject area. Recently, the Hong Kong Green and Sustainable Finance Cross-Agency Steering Group announced its plan towards mandatory TCFD-aligned climate-related disclosures by 2025, and the SFC and the HKMA launched their initiatives on enhancing disclosure of climate-related risks, referencing the TCFD recommendations by asset managers and banks, respectively. With ESG-related matters not only gaining attention from regulators, but also becoming an important consideration for investors, the exchange proposes that to further enhance the timeliness of ESG reports and the relevance of the data disclosed, the exchange listing rules be amended so as to require publication of ESG reports at the same time as the publication of annual reports. The exchange hopes that by aligning the publication timeframes, the interdependency between financial and non-financial matters could be highlighted so that the board could assess these matters holistically and comprehensively. This approach would be beneficial to companies as they can develop more coherent strategies and execution plans. If this proposal with regard to the timing of disclosures of ESG reports is adopted, it will be effective for companies' financial years starting on or after the 1st of January 2022. Separately, the exchange also encourages companies to adopt the TCFD recommendations when making climate change-related disclosure under the ESG guide. For instance, companies should consider describing management's role relating to the assessment and management of climate-related issues, including whether the company's assigned climate-related responsibilities to management or committees, and if so, whether these management or committees report to the board. Processes by which management is informed about climate-related issues, and how management, through specific positions or committees, monitors climate-related issues. With regard to governance, the TCFD recommendations explain that investors and other stakeholders are interested in the role played by a board in assessing and managing climate-related risks, as well as understanding management's role in assessing and managing these risks. Disclosure of this information assists to support evaluations of whether or not climate-related risks receive appropriate board and management attention. In addition, and as part of a company's disclosure and corporate governance strategy, the TCFD recommendations suggest that companies disclose actual and potential impacts of climate-related risks and opportunities on the company's businesses, strategy, and financial planning, where such information is material. In this respect, the TCFD recommendations disclosures should include descriptions of what the board consider to be the relevant short, medium, and long-term time horizons, while taking into account the useful life of the organization's assets or infrastructure, and the fact that climate-related issues often show themselves over the medium and longer terms. Specific climate-related issues for each time horizon, short, medium, and long term, that could have a material impact on the organisation in financial terms. This information could be used not only to inform investors, but also to manage investor expectations about the future performance of an organisation. The amendments proposed by the Exchange will require changes to the structure of the Exchange's Corporate Governance Code, and the Exchange has proposed certain amendments in the consultation paper, renaming Appendix 14 to the Main Board Listing Rules and Appendix 15 to the GEM Listing Rules as Corporate Governance Code. The current appendix is a result of the merger of two appendices in 2012. The Exchange notices that the market often refers to Corporate Governance Code to mean all the corporate governance requirements under the appendices, and the Exchange therefore proposes to rename the appendices as the Corporate Governance Code. Repositioning mandatory disclosure requirements under the Corporate Governance Code as disclosures under the mandatory disclosure requirements are mandatory. It would be helpful to the market if they're set up upfront instead of in the last part of the Corporate Governance Code. And reorganizing the structure, the Exchange proposes to enhance the organization of the Corporate Governance Code by regrouping them into sections by topics and accordingly rearranging the sequence. This is aimed to improve the overall readability and flow of the Corporate Governance Code. The Exchange also proposes to amend the introductory paragraphs to reflect the corporate governance reporting framework and making drafting amendments to improve clarity. One example would be the deletion of the specific term of directors, as I previously mentioned. The Exchange will also issue a new guidance letter which consolidates the additional guidance proposed in the consultation paper, the guidance for boards and directors published in July 2018, several notes currently in the Corporate Governance Code, which the Exchange says would be more appropriately contained in the new guidance letter, and certain market feedback received. The Exchange hopes that the new Corporate Governance Guidance Letter could stimulate boards to rethink how they can carry out their role effectively. The Exchange observed that there is a lack of effort on the part of companies, in their view, to comply with the voluntary recommended best practices and recommended disclosures as set out in the Corporate Governance Code. The Exchange therefore reminds companies that despite the voluntary nature, these recommended best practices and recommended disclosures are important practices for the companies to adhere to in order to meet the principles of good corporate governance as set out in the Corporate Governance Code. The Exchange states that when making disclosures and reports, it's important for companies to carry out meaningful discussions and to avoid boilerplate language and reporting. The Exchange also says that the quality of the disclosures made by a company will not only help the company to comply with the Exchange's listing rules and the Corporate Governance Code, but will also help the company to achieve the goal, which is to assist shareholders in making assessments of the company's corporate governance quality and the board's contributions. Good quality disclosures, in the Exchange's view, should include meaningful discussion of how the principles of good governance as set out in the Corporate Governance Code have been applied, what the company has done in this respect, and what are the resulting outcomes. If there have been any deviations from the code provisions, it's also important for the company to set out the reasons for the deviations and how an alternative approach is more suitable for the company. The Exchange invites comments on the consultation paper with responses to be submitted to the Exchange on or before the 18th of June 2021. So that brings me to the end of the formal part of this presentation. So I'm sorry, we seem to have pretty much reached the allotted time for the webinar. If you have raised any more questions, please let me know your email address and I will try to get back to you directly. Or if you have any other questions, you can email me on juliacharlton@charltonslaw.com and I will try to respond. So that brings me to the end. Thank you again for joining me today. I hope to see you soon at other webinars and have a great weekend.